Golly, why does that camera look so bad? There we go. Cool. Let's see. How does this work? I'm assuming there's a link somewhere and I can copy that and sweet. And sweet. Hang on. All right, I think this is it. Cool. All right. Share entire screen. I've never done this before. And I got a couple things I want to get through, so I figured we would just do it together. Hang on. I got to figure out how this YouTube thing works. Okay. I think this is showing my screen. I think I'm on here. I think the chat works. I think there's people here. I think there's somebody here. Awesome. Cool. Oh, sweet. This is pretty neat. Okay. Where do I want to start? Oh man, there's so many good choices. So many good choices of places to start. Okay, so this is what we're gonna do. This is what we're gonna do. First, I feel kind of bad being excited to do this sort of stuff on my free nights, but you know, I love my family, don't get me wrong, but independence kind of goes out the window when you have a family and kids and obligations and stuff. So these moments of free time, you got to cherish it, right? And this is how I like spending my free time. Okay, so this is what I want to do. This is what I want to do because I've got, like, earnings season's been really intense and I've been working on other stuff. You know, flannel season's kicking off, so I haven't been looking at stocks enough lately. So I figured I would start with talking through my approach, how I look at things. And then I've got this neat little watch list tracker thingy, and it needs updating severely bad. And it's nice having other people on the other end of the screen that, like, there's an extra layer of accountability there. So it'll help me force myself to go through some of these things, either clean them off the list, get them updated, or move on to some other stuff. And I think there's a chat window in this. I don't know if it works like Zoom, but if there's a chat window, then you can tell me if you want to go deeper on something or if I need to add something to the list. So let's do that. Let's kick this off with, I don't know, if I'm assuming anybody who's on this, the few people that are on this actively follow me on Twitter and probably have a good sense for what my approach to investing is. Pretty deep value, like stuff that nobody else likes, appreciates. If someone likes it, I like immediately don't like it, right? So I really want to find things that have that Michael Burry ick factor to it. I feel like my secret sauce maybe has been this concept of like core, special sits, and then this option value thing. So how I bucket my holdings. So I've got anywhere between like 5 or 6 ideas that I feel are good 5 to 7 year holds, good cash, management's deploying it in a way that I like, balance sheet's good, and just like general direction is improving. I wouldn't call them like GARP stocks. They're not growers or anything like that. But they're just, you kind of set it, forget, and the management team you can trust to keep going to work. And then the generals are the like higher turnover, you know, you're looking for shorter term bets, multi-year bets, but like it's mostly event driven stuff. I try to avoid plain vanilla cheap stocks, but occasionally I'll find something like Ziff Davis that just really gets me pretty interested, even though there's not any crazy catalyst to it. I don't really believe in concentration, so I don't mind owning 10 stocks and I don't mind owning 40 stocks, and anything in between really just the quantity of good ideas, I think, is the driver of how much stuff I'm going to wind up owning. I'm also not a big believer in like microcap only. So I consider myself an all cap investor. I'll own some microcap stuff. I own a really tiny company that I'm actually trying to buy like a minority stake in, like a 20% plus stake in, and then go join that board and work with that management team. So I'll do stuff at that end of the spectrum. And then, I probably won't own Apple or something like that, but I don't mind owning big cap stocks if the value's there and they're doing interesting things, right? What else? Yeah, I think that's enough, right? I just like plain vanilla cheap stocks. So that's that. I've got this published somewhere, I think, on my Substack. You can look at it. I don't know where it is. I think it's in this home base area. Yeah, here it is. So here's this big checklist, right, of all the things that I believe. I try to update it once a quarter, twice a year, something like that. The Upslope guy on Twitter, I kind of like mirrored this off of his approach of lessons learned and whatnot. So I like that. Okay. So earnings season's been wild. What am I doing? Why charts? I don't know why I still have a subscription to this, because it's like the weakest of all the tools that are out there. But for some reason, I like their charts and I like their watch lists better than some of the others that are out there. So, okay, a couple things that caught my eye today that I thought were really interesting that I wanted to get updates on. One was this Hanes Brands news, right? The rumored buyout of that stock. So that thing was up 27% today. Babcock, I haven't gone through earnings there, and I want to go through those earnings. What else? There was some stuff that was down a bunch too. Celanese, I want to like this, but I'm not going to look at it. Like this, these mega acquisitions are just comically bad, right? So, a company levers up, spends 3 or 4 times their market cap to do an acquisition, and then shares go from 150 to $40. So I feel like this needs to stay on my radar, right? Like, oh man, look at this 10-year chart, $65, and now it's $41. And had another huge down day on earnings today. And I looked at it, and I think debt to free cash, not debt to EBITDA, is like 15 times. Like, it would take them forever to repay the debt at the current level of earnings. But at some point, this thing is going to get interesting again. So I'm going to keep it on my list, but we're not going to look at it today. That's not anything worth doing. So Synchronos, I tweeted about this one recently, so I feel like I should look at this because they just reported earnings. Let me pull this up. And yeah, this one's got some like whatever. It's tied to B. Riley. I don't think that means anything for this particular company. Here it is. So I thought this was interesting a couple of days ago at almost $8, and then they reported today, and it's down to $6.70. I only glanced at the press release, and I didn't see anything bad. So I don't know. I think it's worth unpacking to see if there's something there, and that thing could be worth buying. QRHC, I kept that on my list. I don't know. I won this thing years ago. It's this little microcap, like waste management-esque company, waste recycling business. Weight Watchers. Yeah, I keep seeing that. Is that worth looking at still? What is that? WW is the top ticker. I guess I don't know what the pre-bankruptcy setup was, but I haven't looked at this yet. So this might be worth a quick look. Okay. Wow. This is lots of stuff to look at. All right. So let's see what's going on with the Hanes Brands thing. Last time I looked at this, it's not quite 10x free cash. And where did I have this before? Sorry if I'm zipping around too much. Just tell me if I need to slow down. All right, I'll turn my holdings on. So the way that I keep this tracker, I guess it's got 116 tickers on here right now. And I'm not really on top of it on like a weekly basis or monthly basis even. So maybe like once a quarter, I'll really give it a good scrub. and pull stuff off, put new stuff on, update notes. I try to link, if I've like built a workbook, I try to build like a workbook anytime I'm doing a write-up, and I'm a huge fan of these like cascading vertical tables. I just think it's such a nice way to see financial information. So I'll try to link them to each of these as I go through it. And then if I'm really feeling frisky, I'll even add like a target price with potential upside to it, and then some kind of evaluation parameter around it. But again, I'm not always consistent about updating this. So this is my chance to kind of prune some items on the list. And actually, I own some Ziff Davis, so that's technically a holding. Okay. So Hanes Brands. I know that one's on here, or it should be. Okay. So the last time I looked at this, I was pricing it at 9x free cash. They were calling it $300 million per the latest earnings. And I don't think that's changed. It's still 3.3 times levered. And I don't think, net sales increased 1.8%. I know they're down to just the like basics undergarments category, but I don't know how much of a grower this really is. And now they've got the rumored buyout. What is 300 million of free cash per share? So at $6, you're paying 7 times. This 300 million includes some working capital benefits. So, yeah, I don't know. I don't know that this price target's still too far off the mark at the moment. So, I think there's still a lot of stuff on my list that's got better upside than that. And I can't opine on. I mean, to me, I see this as maybe a potential exit opportunity for me, because I think I looked at buying this during the COVID tariff stuff. So in this $4.50 to $5 territory. So wow, that's a really nice move today. Cool. So this might actually be closer to, should I rotate out of it? Because I don't know that this is a business I care to own long term or anything. So I'm going to leave that price target unchanged right now. I think that's probably reasonable. Okay. So Weight Watchers. Tell me what's going on Weight Watchers. Is this market cap right? 3 billion? That doesn't sound right. This was a post reorg, right? Keeping that up because I need to look at Synchronos. All right, what's going on here? And this is my method, right? It's just combing through some stuff. Typically, I'll pull together. If I'm doing a quick value write-up, I'll wind up using Ticker to build some like financial tables going back in time. That'll help me get like the historic context. Is this the new? Okay. Let's see if this data is even correct. If anyone on here is following this, let me know if this is. Let me know if these figures look on or off base here. 750 million in revenue. Positive operating income. No cash flow, but it's a reorg, so I'm assuming that has a whole bunch of interest expense in it that's going to go away. Revenue's down 6. So they just reported results, and it sounds like people are saying results were way better than what they were thinking it would be based on the reorg doc. So 150 million cash. What is that? That's 465 million of debt. So 310-ish. Some other stuff. Actually, positive equity balance. Interesting. Okay, subscription revenue. So this is okay. This is only a really stub period here. Okay, so this is kind of this is like the real results here. So okay, still positive operating income and positive compared to where it was at last year, despite lower revenue. What's the market cap? You said should be 10 million shares outstanding. So this is like a $350 million company. Oops. So 10 times 33 plus 465 minus 150. So like $650 million enterprise value. Is that what we're looking at here? I don't know what's in restricted cash, but I usually don't include that in an enterprise value calculation. And 1/4 of operating income was like 40 million plus or minus. Huh. But like, what is the business now? Like, what do they do? So it's subscription revenue still. Clinical subscription. Does this have like a hims and hers type aspect to it? Like, is that part of the thesis here? I mean, I don't think it looks like it's meme stock priced or anything at the moment, but $19 per sub. All right, I gotta add this to my list. So WW is the new ticker. Well, it's not called Weight Watchers anymore. I'll leave it at high. Okay, so this is a post reorg. Cool. 10 million shares. I'll call it 350 million market cap. Yeah, they're selling GLP. Okay, so they're not a compounding pharmacy. Okay. And have their legacy business in decline. Okay, so like there's moving parts to what they actually have. So what does that business look like in like 3 years? I don't know. I guess there's probably a presentation that I should look at. I guess this is one that I should probably do a closer look at. But all I want to know is like has the easy money been made in the reorg situation? Like I know people were talking about buying this before they actually finished that reorg process. Like what is the stock up a ton from that pre-reorg stub equity to where it is today? Maybe it isn't. I mean, it hasn't moved much. Lately. 27 bucks, I guess. I'm assuming this is like first post reorg trading period to now $33. So it hasn't really done much in that, call it month and a half of trading. Interesting. All right. I'll have to take a closer look at this one. Maybe there's like a good investor presentation though. Oh, here it is. Okay. This is what I needed. Okay, took the debt down. So, okay, here we go. Okay, so this was, these are quarterly numbers. Wow. So 150 million of EBITDA in 24 and trailing 12 is 166. So this would be really cheap if those numbers hold up. Oh, this is just like a 2-page document. Great. And I'm assuming this financial information in ticker is probably pretty accurate then. So you got revenue from 1.5 million in 2018 down to 750 million TTM. So not stellar. But maybe there's something there. Okay. All right. So if this is, call this 150 million times, I don't know. I'm just putting a 7x multiple in here as a starting point. 150 million EBITDA times 7 minus 465 minus 150 net cash divided by 10 million shares. $73. That sounds outrageous. 7x. It 150 million. Okay, that's a starting point. That's a starting point. And we'll trim that back because this is definitely like a declining looking business. But even if you price that at 6 times EBITDA and EBITDA is 150 million, then that gives you pretty good upside from there. So okay, yeah, I'm gonna have to move that one up. Move that one up my list. I want to unpack this Synchronos thing because this has just been itching at me today. So I posted about this one. It's a little software company, a tiny little software company. It was 100 million market cap. They got a refund, tax refund of $34 million, and they're using that to repay really, really expensive debt. And they've got multi-year contracts. I think it's kind of crummy software. It's just like, if you're a Verizon customer and an AT&T customer, then you get access to this software that can like house all of your photos and be like your own little personal digital bank, so to speak. So at 850, it was 100 million market cap. At the time, 143 million net debt. That was with the tax refund that they got at the end of the quarter, and they're guiding to close to 55 million of EBITDA. So this thing is like insanely cheap. Oh, shoot. Pause. Awesome start. I got my youngest who just had a poop emergency. So good times. Have kids if you don't have them. All right, Synchronos. So this is really cheap. I'm just going to jump right back into this. So second quarter results. What's going on here? Revenue is down, and I remember seeing that. By 2%. Okay, 2% subscriber growth in their cloud business. Subsequent to the quarter, they received their tax refund of $34 million. 75% of that went to this $25 million term loan. And I think that term loan is insanely expensive. Let's see. I feel like this is one of those stories where, you chip away at this thing and the stock could get really interesting. And what I like about it is they have contractual high margin revenue for years. Where is this? Okay, term loan. In compliance. Where's my rate? Here we go. Wow. So this is SOFR, which won't be less than 2.5% plus a 7% margin. So this is really, really expensive debt. And they just repaid $25 million, which they think will cut. Where do they say interest expense will fall? So that will save $2.9 million of annual interest. $100 million company. Well, it's not a $100 million company anymore. It's now a $77 million company. And guidance moved to come on, where's that guidance? There we go. All right, so this is what they're targeting. 2025 outlook. 170 to 180 million revenue. I'll pull up the long run numbers here in a second. Recurring revenue is 90%. Gross margins in the 78 to 80 territory. 52 to 56 million of EBITDA at 30% margin. So this is a software company, right? And then 11 to 16 million of free cash. But the free cash excludes 4.5 million of term loan refinancing fees, and it excludes the tax refund. Okay, so if you say that's one time, right, and you've got 11 to 16 million of free cash, then tack on another, 3 million go forward. That's pretty interesting for a $77 million company. Where, if I remember from their last investor presentation, here it is. Where did I see this? Contracts. Where do they talk about the contracts? Okay, so AT&T is on a 3-year contract extension. SoftBank is on a 5-year agreement, and Verizon is through 2030. SFR is a 3-year contract. So that's a lot of time to execute, even if you don't think it's an amazing business. And I wish I could describe to you what they actually do, right? I mean, I think this is just like consumer oriented. This is just these mobile phone providers being able to offer up this service to consumers generally. That's just industry growth. That's not them. And it's tough to look back at the historic financials because they had another business that they sold. So let's pull this up. I will add Weight Watchers to my list. I'll take another look. My immediate concern is that I still don't know what that business will look like in 1, 2, 3 years from now, because it looks like it's just going to be a continual revenue decliner. So this is SNCR is what we're looking at. This historic period includes another business that they have now sold. They sold that to one of the Constellation spinoffs. I can't remember which one. So that was another software business inside here. And now what's left, this 173 million from the last 3 years, which they've guided to 170 to 180 million again in 2025. So it's just kind of like flatlining. It's not really growing, but earnings are improving. Let's take a look at what free cash is doing. Free cash is pretty stagnant, right? So pretty much zero in 2023. Negative in 2022. I'm assuming these are all your intangible software development costs. 16-ish million, maybe 14 million in 2024, and then 11 to 16 million. So it's getting better. And now that they're chipping away at the debt, which they haven't really been able to do in recent years, looks like they repurchased this preferred stock that they had. So it's a nice little balance sheet cleanup story and an okay business with long-term recurring revenue, not long-term, but medium-term locked-in revenue. High margins, good free cash, and the balance sheet's turning the corner while the stock it's off of its lows, kind of. I mean, I guess at one point it was as cheap as $4. in 2023. Everything was cheap back then. Man, I don't know. This one's really, really interesting to me. And I don't even know that matters what sort of multiple you put on it. Let's see, where do I have this thing? Oh, I don't even have a target on here. Cool. So I guess if we said free cash, like let's just give them credit for the low end, 11 million. We'll tack on 3 million for debt savings, and we'll call it 14 million of free cash. What's the share count? I don't even know. I'm trying this BAM SEC thing, by the way, and I really like this compared to going to the actual SEC Edgar filings. I don't know if it's going to be worth the money. 11.5 million shares outstanding. 11.5 million shares outstanding. SOFR plus 550 is what you're saying? Okay. 11.5 million. That's $1.20 a share. $1.20 a share in free cash at the low end. Now, I guess I'm not taxing the 3 million of interest savings, but who cares? I don't know. Throw that 7.5 multiple on it. And you got 36% upside. That's not that exciting. That's at 7.5 times fiscal 25 free. I guess this is free cash flow. We'll call that 14 million, 20 a share. Well, that's pretty interesting to me. And you know that if they're repaying that debt again next year, right? Every 5-10 million that they chip away at that is going to be pretty additive to free cash flow over the next 2 or 3 years. I don't know if they can get revenue growth going, but it just feels so cheap with a couple of things that are going their way that it wouldn't take a whole lot to get some momentum going. Management saying they can sign one new customer in 2025, not in projections. Seems like these are big contracts. But big customer contract, yeah. I mean, I think that's also the huge caveat, right? Is you're perpetually gonna have like 3 customers in this business. So I don't know. This one's like kind of top of my pile at the moment. I like the backdrop of that. I like those balance sheet transformations where you have debt being like seriously burdensome, and they had this expensive pref in there too. Now the pref is gone, and the balance sheet is way more manageable. And I think if I remember that original press release, they said something along the lines of there's another small piece of tax refund coming. It's 34 million in total. Yeah. 34 million in total. Never mind. Scrap that. So I don't know. This one, I really, really think this is interesting because the balance sheet's transforming and it's so left for dead. And I don't think even in this comment, I don't know that anyone was really excited about it, except for like 2 or 3 people. So, okay, I'm going to put a pin in SNCR. I think this is really low. I think 7.5 times a run rate free cash, and that's their low end number is probably low. And it doesn't take a whole lot to get it to move higher from there. I don't know what the rest of the balance sheet looks like. There's not really a lot of leases. It's really just the debt, some accruals. I'm surprised they don't have more AR, just given who they're working with, but that's okay. There's no equity. It's software. R&D is really high. Wow. So yeah, I don't know what $12 million of FX also seems really high for 42 million revenue quarter. Holy cow! Wait, what? How is that possible? How do you have a $12 million foreign exchange loss in a single quarter on a 42 million revenue business? That just doesn't compute. Usually they have like a geographic thing. Oh, weird. So almost all their revenue comes from North America, and yet they had a huge foreign currency loss in the quarter. Non-cash, but still, it's a P&L impact. I bet all their people are located overseas. But other people are. Oh, this is the Q, not the K. That's all right. Okay, we're gonna move on. We're gonna move on from Synchronos. Check that one off. I'm gonna nudge this up so I can remind myself that I actually think it's more valuable than it is today. I don't want to anchor to the fact that it just got beat up today, and I don't know why. I didn't read the transcript, but my guess is if we pull up the transcript, let's see. Is this the transcript? Yeah. No. Still getting used to this BAM SEC thing. I use Ticker mostly for my financials and building tables. Their data is sometimes inconsistent, but generally I like it the best. Yeah, there's like no one even on this call. There's like one guy asking a question. Okay. I really like that idea. All right, let's just comb through the rest of this. Quick hits. Lionsgate. I have done zero work on this since the Stars spinoff. I love the Stars. I guess it's technically the RemainCo, but we'll save that for another day. I like that setup a lot. I have not looked at Lionsgate, but Lionsgate has drifted lower, and it makes me want to look at it more. My target is old. Let's delete that because it's not relevant. That was pre-spin price target. Amcor bought Berry Plastics, and I liked that business and had some success owning that in the past. And I figured, hey, if Amcor is buying it with stock, I should maybe look at it someday because Amcor has also done nothing. So I don't know. I don't know that it's anything crazy exciting. I just figured this is maybe like a someday idea, not a today idea. Comcast, man, it's just so beaten up. And I like the fact that they're spinning off that cable business. And I really like that those cable spins, I think someday could work. And I bet none of them will get spun without someone doing a reverse Morse trust transaction. And it'll maybe be Comcast and like Warner Bros. Or something. So I just keep this on my list. I leave it as high because I think it's interesting, but I haven't priced it out. Ziff Davis is just, it's trading at like 3 times free cash, right? They're guiding to $7, and the back of that napkin math is $7 a share of free cash, and it's a $35 stock. So this is one of those like plain vanilla cheap stocks that I try to avoid. And here I'll pull up my my tables, my handy dandy tables. So this is quarterly cash flow right here. And this is what I liked about it. When I first looked at it, I was like, okay, it's cheap. And I think the market's discounting management's capital allocation, right? I think that and the AI could destroy publishing / search, I think is the general thesis here, the combination of those two factors. So when I looked at it, I was like, okay, set all that stuff aside. They just spun off Consensus Cloud, which is arguably the crummier of the two businesses here, like subscription fax services. So since then, you have this 22 to 2023 time period where, they mostly just repaid debt and accumulated cash. Like they really didn't do a lot of M&A. This is that time frame. They really didn't do a whole lot. And then since then, in a shorter time frame, not only have they done way more M&A more consistently and smaller stuff, but they're also way more aggressively buying back stock, including the last 4 of the last 5 quarters. You got $250 million spent on buybacks, and this is a $1.5 billion company. So with like no leverage, right? I mean, there's some debt, but not really. So even if you were to include the average M&A spend as part of your free cash flow calc, it's still insanely cheap. So I don't know. I had a lucky roll of the dice with Consensus Cloud, and I thought that when these guys reported earnings, there's one slide in the very back, this one right here, this one, organic revenue growth, right? So they had their first quarter of organic revenue growth in like I guess this is only 4 quarters, but still, that's a pretty big number compared to recent trends. So I own this one. I don't own a ton of it, but I like it. And I think if they put up another 2 or 3 quarters of decent organic growth or results that aren't falling off a cliff, then I think that, to me, will say the AI thing is perhaps less of a risk than what the market is baking in for them. So I don't know. We'll give that one another like 3 quarters to play out probably. I do think it's probably worth $50 to $60 if it's truly fairly valued. The last time I priced this thing was at $6.75 of free cash per share, and I think they're guiding closer to $7. Yeah, here's my note. Super cheap, but will anyone ever care? Probably not. PRAA, I'm going to move this to watch. I haven't looked at it in a long time. This is the old like consumer receivables purchasing and collections business. I don't know. I want to like it. I feel like when the markets are crummy, that would be their opportunity to reload, buy receivables on the cheap and service them. But and shares are, well, they were more beaten down. Let's see. Yeah, it's a pretty awful 5-year run. I just don't know that it's like crazy high on my priority list to unpack what's been going on there for the last few years. Site centers. Every time I ask the investment community about this liquidation idea, nobody seems to like it, which makes me like it, right? I think everybody's really obsessed with the net lease idea, which is fair. But I don't know. This thing is just, they spun off the curb line business, and then this thing has just drifted since then. Yeah. So here's your spinoff time frame, right? And just like straight down, $17 to $11. I think the last time I looked at it, if you put an 8.5 cap on the rest of the portfolio, which is like totally painting with a broad brush, then it's I don't know, in the $15 to $17 to $18 territory, something like that. So yeah, I don't know. This one to me still seems really pretty interesting. Curb line, yeah, that's the other side of that spinoff. They loaded it up with cash. I guess I last time I looked at it, I priced it at a 5.5 cap rate, which is really pretty aggressive. So at today's price, that would make it a $30 stock, and it's 22 today. So I don't know, maybe that needs to get nudged lower. I don't think I'll buy that. It's not really my cup of tea. Maybe I would even put that as low. Yeah. I don't know. I should kick it off my list, but I just like the idea that they REITs are not a business that generally carry net cash balance sheets, which I think is really fascinating, right? Like, I like industries where you've got a player who has an uncommon balance sheet. It's what I love about Sandoz in generics. I don't know. We could go run a screen, and we're probably not going to find a lot of REITs with an enterprise value below the market cap. Like, that's just pretty fascinating to me. Scholastic, I'm probably going to put this down to low now. Scholastic, what did I like about this? I looked at this a while back, and they own some real estate, and it was cheap, excluding the real estate factor. So like not baked into the EV. But then I think they just recently said, hey, we're going to sell the real estate. There it is. Let's see. Okay. Complete analysis of options to leverage this real estate. Investment partners for potential sale leaseback of their New York City real estate. So the last time I looked at this, let's just see, what were my notes? Scholastic, there it is. I looked at this at, I guess this was close to $20, so it's maybe not too far from where it is now. And they have 3 businesses, and one of them was just a huge money loser. One of them was doing okay, and then the other one was like not even worth owning. But they were cleaning house in one of the underperformers, and I think it was starting to get some traction. It was really the backdrop of the actual fundamentals for the business. And then you've got the owned real estate, and they've got this, downtown New York City, Manhattan real estate. They got a big fulfillment center, and if they put that stuff on the block, oh, you're on top of it. They're selling their Soho office real estate. Some people think 350 to 400 million of value. What is this? This is a $600 million company. Yeah. So I don't know. That's kind of fascinating, right? The core business though is probably not crazy exciting. So let's see. Yeah, so I guess I was thinking of 26 to 31. Now I remember, jogging the memory. I looked at it. I thought maybe 26 to 30 bucks. Then after I did the work, shares sold off to 16. And I was like, oh, okay, this is interesting at 16. And then I did nothing, right? I just let it sit. And now it's back to 25. And I'm like, all right, cool. I think it's probably time for me to move on from that one. I don't know that I'm going to get excited about that. Weight Watchers, I'm moving that towards the top of the pile. This 52-week low is probably not right, but that's fine. AMN Healthcare. Where I feel like I've look at the stock price. This is the healthcare staffing business. Yeah. Yes, that's what this is. Oh man, just so many charts look like this in the world of everything on my list. So if you don't like this type of chart, then I'm sorry. There's a guy on Twitter who is, I think, really smart and has commented on this name in the past. Let's see. Let's see if I can find this. Danny Ocean? Yeah, this guy. Let's see. I'm sure this guy's not on my chat, but if he were, I'd love to hear his thesis on it. What did I like about this? This one needs to justify itself to stay on my tracker. Okay. Massive, yeah, what you would expect, right? Massive COVID spike in revenue, 66%, then 30% revenue growth, gave a whole bunch of it back, but still trending higher than where it was pre-COVID. Earnings went with it, but now, oh man, this story is so familiar. I've seen this a million times, right? Like steady earnings pre-COVID, COVID comes, super earnings for a period, and then earnings fall harder than they did pre-COVID because they probably added cost and infrastructure to the business and we're not expecting to lose that much additional revenue. Maybe they did an acquisition because interest expense is way up and there's impairment charges. So it's almost a certainty that they've acquired a bunch of stuff since then. Okay. Not a ton, but they have. So 300 million of operating cash, some CapEx. It doesn't look as terrible of a business as like the temp staffing agencies. And the market cap is 600 million. Interesting. Okay. So you got 300 million-ish of operating cash flow on a $600 million market cap, assuming that that's correct. Granted, it's coming down. Yeah, okay. That looks insanely cheap. Assuming there's something happening in the near future. I guess it's levered, right? You'll have that. But yeah, like 5 times free cash. So I feel like I've got time to look at this sort of business. So when I see companies like this where the fundamentals are falling, not off a cliff, but like they're drifting lower and shares are down a ton, I love to do the work and then just sit on it and like see, okay, maybe it's 2, 3, 4 quarters, maybe it's 2 years for them to start turning the corner and coming back. Because you do the work up front and then maybe you can catch it once they start to get some momentum going. So Monarch Casino. So I'm leaving this one as high. I haven't done the work, right? It's got a gap here. Site Centers. I'll do evaluation on that one eventually. I will do this one. So I'm tabling this. That one's worth a look. Okay. Monarch Casino. Man, do I keep this on the list? It's been such a good run. what I like about Monarch, there's only like 2 publicly traded casino stocks that own the ops and the real estate, and Monarch is one of them. And it's just a really clean financial story. I love companies that report like GAAP earnings, and like that's their barometer for financial releases. There's so few. And these guys are one of them. They really just they lean on their GAAP financial results. And they own 2 properties. It's been a steady top line grower, mostly I think entirely organic, actually. Let's see. Entirely organic, yeah. So fueled by CapEx. CapEx cycle is coming to an end. Now they expect operating cash flow to come. And yeah, the stock is already kind of reacting to that. And now they're buying back stock. So it's like a capital allocation inflection story on top of everything. So I'll call it 100 million of free cash TTM. Balance sheet has no debt, right? Also insanely rare, and for any casino stock, insanely rare. So no debt, and it's 1.8 billion market cap. So it's trading at like 18 times trailing free cash or something like that. Yeah. Well, this is next 12 months. So analysts must be thinking there's more coming. So I don't know. It seems like a decent company with, again, unusually good balance sheet, but I don't know what's going to get me excited unless it's hanging more around their 52-week low as opposed to the 52-week high. So that's Monarch. I'll look at it eventually. I own some Golden Entertainment, and that one's been a total dog. And they also own their property and their operations. And they just sold an asset recently for what I thought was a really good price, but it's just drifted lower too. So a complete opposite level of performance that Monarch has had recently. Brunswick. What did I do? What did I say here? I priced this thing at $57, and they're going into like a down cycle. So Brunswick might need to move into the watch phase. It hasn't gone anywhere. Oh man, it's really a nice chart actually. They haven't gone anywhere. But when I first looked at this one, I'll pull it up. BC. There it is. Ooh, Babcock. Gotta look at that Babcock. I first looked at Brunswick in 2023. It was a $75 stock. It's now 50, right? 50, 60 bucks. And they sold like their billiard business a while back. Their consumer businesses were long gone. They still have the boat manufacturing division, but they basically recycled the capital into this thing through a couple of decent sized acquisitions where it's mostly a parts and accessories business and an engine business. It's still really tied to, where is this? Yeah, it's really tied to the boat cycle, but like there's still a hefty maintenance component to it. And like the parts business and the service business is a nice, it's not cyclical, but less cyclical than someone buying a brand new boat. But you can't fight an industry downtrend. So at the time they guided a $9.50 a share. Where are they now? Let's see. Come on, I know they reported. There we go. Whoa, there's a lot going on this website. All right, earnings release. Let's see. Let's just see if I should pause looking at this thing for a while. So, okay, the propulsion segment's actually coming back to revenue growth. Parts and accessories is back to revenue growth. Their navigation business is 4% decline, and boat manufacturing is a 7% decline. So that's pretty solid. I think that's much better than where they had been. Okay, $3.25 in EPS compared to $9.50 when I was looking at it last. So in just insane amount of cyclicality in the financial structure for this business, right? Which also means that 350 is probably closer to trough earnings than it is to peak. So it may make sense to look at it through the cycle earnings there. Okay, so I'm gonna leave this. This is just, I think I priced this off of EBITDA at the time. Yeah, that's what I did. One more look. Let's just see. What are analyst estimates? Okay. Revenue decline. Expecting them to start turning the corner in 2026. EBITDA turning the corner. Wow, it's like half of where they were in 2022. But again, it's like was that a super normal period of earnings? Probably. Granted, they own some different assets at that point in time. I'm moving Brunswick down to watch. I feel like this is a business that I don't know. I could own this at some point. I think it's a decent business. They generate a good amount of cash. They're a good market leader in that space. I just don't know what will get me over the hump. Oh God, Peabody. Oh, this thing's at $18. Wow. Okay, I haven't looked at this in a while. Did they decide not to do that acquisition? All right, final allow cookies. Let's see. Man, this thing got down to $9 and it's now back at 18. I really have been out of it for a while. Let's see. Acquisition update. Well, they haven't decided yet. 4 full months. Okay. Interesting. Okay. August 19th. That's coming up. Cool. Well, I'm assuming the market would really like it if they did not pursue that acquisition. And maybe that's why the stock is up a bunch. I remember looking at it and thinking that acquisition just turned it into like more or less a call option because it annihilated shares and gave them some serious production upside if they could get that thing going. So I'm downgrading that to watch unless anyone thinks it's insanely exciting for one reason or another. I'm guessing if they don't do that deal, they probably if they don't do that deal, then they probably have a bunch of internal cash that they can turn around and use to do other things, and maybe buybacks come on the table. So maybe it's a nice like inflection story if they wind up passing on that acquisition and like doing other things with the cash instead. Maybe that's the thesis from here. I don't know. Haven't done it. Oh, hey, good to see you. Thanks for joining. No, you're just on time. I'm probably going to hang out for another 30 minutes or so, combing through my list. All we're doing is we're updating my stock tracker that I haven't touched in like 2 quarters. So, all right, Lendway. Okay, Lendway. Has anyone looked at this? Does anyone remember this stock? This is the old Insignia Systems that I don't remember if there was an activist in there. I think it might have been the cable car guy. And then the Air T guy came in, and then he took control of the company. And then they did like a massive LBO in this. Let's see. Oh gosh, there's not even no results in this thing. Is this an OTC markets kind of company? So Lendway, I've kept it on my list. Because sorry, I'm jumping around. I get all excited with my tabs. I kept this on my list because, first of all, because that's the chart, right? It got down to like $3, $4, and at one point they sold the core Insignia business, and then it was just a cash shell, right? That was the story. It was an NOL shell, and they said we're going to go find an acquisition and use the cash. And then instead of finding an acquisition, they were like, we're going to start an ag lending business. And at the time I owned it after they sold the Insignia company. I was like, oh, fuck that. Like, I don't want to have anything to do with starting an ag lending business from scratch. they abandoned the ag lending business and said, okay, we're going to buy Lendway acquisition. Let's just see if I can find the news. Blumia, yeah, this tulip manufacturer. This was February of 2024. Tulip manufacturer, and they spent $47.5 million in cash with like all debt. So let's see. Okay, they do report K's and Q's just on OTC. I guess I probably could have checked BAM SEC. So $5. I mean, this thing is freaking tiny, right? This is a $9 million company. This is a $9 million company, and here's their insane balance sheet, right? Where is it? There's your debt, which is now 35 million. 35 million in change. 35 million in change with not much cash. I'm assuming this is hugely seasonal as well, but a good amount of equity. So you got a $9 million equity value with like $35 million of net debt, ignoring all the other stuff that might be on here. This is 3 months. 12 million of revenue. And look at that. They're starting to turn the corner. So operating income, 1.4 million. Previous year, which this would have been, they had just closed on this acquisition in this 2024 quarter, 1.6 million loss, right? So like, I don't know. I don't think they've strung enough quarters together to get a full picture of this thing. I don't know. Let's see if I can get, God, these results are this is just not usable information. Here we go. Accept, yes, go away. Okay, so here we go. We got 4 quarters. You can see the seasonality. So this upcoming June quarter is going to be probably their seasonal best quarter of the year. And assuming the trend continues, based on Q2 profitability at the operating income level, it might be a decent quarter here soon in June ending quarter. So, man, 3.9 million of operating loss in their seasonal slow period. So, gosh, this June quarter would have to be enormous for this to pan out and be a good value from here. So let's just say there were some transition hiccups, right? So the most recent quarter grew 50%. 50%. I don't know. Let's just take half of that. 16.8 million. So maybe the next quarter, 21 million in revenue, right? And then let's see this gross margin here. 3.9 divided by 12.4, so 31% gross margin. That's better than what this quarter was. Let's take that on top of 21 million in revenue. I don't know. Looks like they're taking some SG&A out of the business. No, I think kind of looks like it, right? Minus 3 million, 3.6. So maybe they have a 3.6 million operating income quarter. It still puts this thing at basically break even at the operating income level over the last 4 quarters if they produce a huge Q2. So granted, I'm assuming all the acquisition amortization is in there too, but still. So I don't know. I look at it and I'm like, this is worth more work, I think, right? Let's see. I need to move this one to the top of the pile. I just need to figure out what the hell is going on here. And yeah, I have this tagged as ag. It's definitely not ag. It's now, I don't even know what you would call that. I'm just not even going to write anything. So Lendway is I just need to do a quick value post on that because I feel like if it works, and you probably can't project the future earnings profile well enough, but I don't know, the thing could be multi-bagger depending on what that acquisition looks like. And by the way, there's probably acquisition docs. I'm assuming they had to put some disclosure out around what they were buying, right? So we might have some historic information. Shit, we're just gonna look that up. We need to look that up. Sorry. Pause. Lendway acquisition. Okay, so they announced the acquisition in February 2024. Let's see if BAM SEC has this. And let's see, Lendway. Sweet. Okay. 2024. Let's see. Financials. Of course not. All right. Here we go. Okay. Blumia historic financials. Oh, sweet. Okay. So this is what they bought. Granted, this was in that post-COVID period where you probably had some weirdness going on in the financial results. Operating income was 5.4 million and 3.6 million in those 2 years. So if they paid, what's this? 47.5 million. Okay, it looks like they only bought 81.4% of the company, really, and that's okay. So 47.5, so 58 million. So they paid like 10x EBITDA maybe, or 10x operating income for that thing, assuming that's accurate. And then let's see, was there any DNA? There sure was, but they're investing in some capex too. So, gosh, $6 million in operating cash. So this is, I got to do some more work on this. There's potentially something to this, right? They bought a company with $6 million of operating cash in 2023, year ended 2023. And it's a $9 million market cap. Okay, cool, noted. Adding that one to the list. Pitney Bowes. I don't know. I read the thing in Barron's on this. Let's see. I think Merle Whitmer she talked about it, and I read it and everybody talks about it on Twitter, and I don't look at it when they talk about it, and I know that I should. Come on, where is it? Merrill Whitmer, Pitney Bowes. Like, should I just buy this thing? Is that what I should do? I'm cleaning up old tabs. Sorry. Clean up. We looked at Brunswick. We looked at Peabody, Lendway. Probably shouldn't talk about those secret gems that is not on nobody's radar. Okay. Merrill Whitmer. Here we go. Oh, man. I got to go get this through. My wife's work has access to this, but oh well. All right. I'm not going to do that. I'm going to pause on that. But Pitney Bowes seems to be a favorite of everybody's. And, I haven't looked at the business in a long time. I think my PM asked me to look at it in like 2014. And when I worked in the industry. And I didn't like it then. And I kind of don't like it now. What's this? Huh. Oh, did they sell something? Is that what this is? Okay, so huge operating cash. And I want to say they have like a financing subsidiary in there too, repaying some debt. They got the dividend, and now they're starting to buy back stock, right? Because it's like a hedge fund guy as the CEO. Is that the story? Is that the general story? No, nobody's long this thing and really likes it. PBI investor relations. All right, if I can't find in like 5 minutes why I should keep this on my list, then I'm taking it off. Let's see. Yeah, this guy, Kurt Wolf. Let's just take a look at what that press release says. All right, here's your earnings release. Okay. 150 million share repurchases in 2025, 3x leverage by end of second quarter. Okay. and a comprehensive strategic review. This is in May. Guidance isn't in that press release. Okay. All right. So you had earnings growth, revenue down, earnings up, revenue up, earnings up. Okay. And they're guiding to, okay, $1.20, $1.40 in earnings and $3.30 to $3.70 in free cash. And it's a $200 million company. Okay, so it's a high free cash flow yield type situation with, call it 3x leverage. Is that where they're at? Let's see. No, just talking about leveraging their strengths. They talked about getting down to 3x leverage. So it's like a mid-teens free cash yield with 3-ish x debt to EBITDA, assuming this is wrong. And now they're starting to buy back stock, right? Is that the general consensus view here? Yeah, all right. I don't know. I'll bite. I'll take a look at it. I'll leave it on there. If everybody says to look at it, then... Oh, yeah, that was my note. FinTwit favorite and Meredith Whitmer, sorry. Yeah. And Barron's. United Foods, I just looked at this one. I don't know. It's the old Super Value business, the grocery distributor, and the grocery distributors are like maybe the least exciting of the bunch. They just don't strike me as great businesses. But this team is actually doing a decent job executing on their plan. What did I peg it at? I said if they hit their targets, just right down the fairway, no outperforming. They basically, the gist is they put together a 3-year plan. They're 1 year into that plan, and they're exceeding plan. They got sidetracked by a little cybersecurity incident, but they're pacing ahead. And if you just say, hey, they hit their targets, no like upside bonus gravy performance, then I thought, okay, at 6 to 7x EBITDA, this could be a $38 to $50 stock. It might be high. Super Value never traded at that sort of multiple. It was like a 4 to 5x EBITDA business, which is pretty much where this is trading right now. Oh, I know you like UNFI. Yeah. You weren't enthusiastic, but it has a huge revenue base. Yeah, I agree with you. I think it's probably worth like, $40 potentially. That's like 6x EBITDA. And then you get some bonus if they wind up outperforming that. So I don't know. I don't know what gets me over the hump on something like that relative to other things that I've got on my list. I'm gonna pull all these off. We'll keep looking. Okay, I got like 10 more minutes in me. Then I gotta go take the dogs on a walk. Okay, BRSL. This is the old IGT business, and they just sold that and did a special dividend, and now it's $15. I feel like it's just lottery, right? It's just a lottery business now. Maybe 1% point. Yeah. I'm with you on the margin expansion concept there. Like, and historically, if you look at that business, I think you're talking UNFI still. It's like pretty clear that they're wildly underperforming from a margin standpoint. Yeah. So these are historic margins, right? And even if you go way back in time, like standalone Super Value, which was a horribly run business, even they were like 2.5% EBITDA margin business. So I don't know what these guys did in this 2019 to 2024 period, but it seems like there's room to clean it up. BRSL, I don't know. They just paid the special dividend, I think. I don't know if I'll wind up doing any more work on this, because they just won this huge lottery contract, and I think it's now a big part of their business, right? Let's see, did this dividend get paid out already? Yeah, it did. Cool. paid on July, $3 a share on July 29th. Okay. So that capital is gone, and now they're left with a different looking balance sheet and a different business because they don't own the core gaming company anymore. So I don't know. I'll probably put this down to watch. All right. DNOW. Oh, man, I really like this stock. So DNOW, this is an old National Oilwell Varco spinoff. It's their MRO business. So kind of like a Fastenal type business, but really specific to oil and gas and now utility customers. Pipes, valves, and fittings is the common acronym. So this stock has been kind of a dud for years. I guess that's not that dud-like, right? It's done okay. But I called this out. I said, hey, these guys should just merge with this other company called MRC, which was like the same size, market cap, identical market cap, different enterprise values. And they just said they were going to do it. So now that's closing here by the end of the year. And I think that'll wind up creating a ton of value. And when they put that combination together, let's see, I wrote this up. So they put this deal together. Yeah, I got to 188 million pro forma shares. So call it a $2.7 billion company. Pro forma net debt at 200 million. So this is practically unlevered. Working capital can be intense because this is, a distribution business. If you're growing or you're declining, that's going to have huge swings in positive or negative working capital flows. So if you strip the working capital out, it's like 10x, basically call it operating cash flow. So it's not crazy expensive. Rig count isn't helping you here. But I think they were really conservative on their estimates of cost synergies. Like I think there's a ton of branch overlap. Where's this slide deck? Yeah, here's your combo. $430 million EBITDA business is what they're pushing, right? So basically equal levels of EBITDA merging here, and then 70 million of synergies gets you 430. So this is a really cheap stock still. No leverage. I thought this was insane. They're calling this out on like, hey, here's our capital allocation plan. We're going to take this to a significant net cash balance sheet within 2 years. Like, I don't know why they need to do that. That doesn't make any sense. So I don't think they'll wind up doing that. I think they'll wind up using cash to deploy elsewhere. But even without that, I think you get to call it 11%, maybe a little bit better earnings growth over the next 3 years with a solid net cash balance sheet by then. So some upside if they wind up deploying cash in a better way. So I don't know. I think I priced it at 21 bucks. Let's see what happens if I drop that in here. Okay. Not great, not terrible. Let's see, what was that? That's 8x. 8x. So EBITDA, 430 million. And this is distribution. All right. So that's DNOW. I like that one. I think that one could be a good core holding for me because that management team and that business have done a really nice job of running that company the last couple of years in an industry that sucks. Here, that's MRC. Where's DNOW? Here it is. This isn't sales and everything, but yeah, you get the picture. Like they haven't had to put anything toward the debt, so the balance sheet's pristine. They've slowly started to get back into deploying into some M&A, started getting into buybacks. Operating cash flow is strong. Like they did a nice job of turning this business around, cleaning up the balance sheet. Then they were net cash and then took that net cash balance sheet and merged it with MRC. I just thought it was like a really smart deal. And to do that as a merger of equals makes a ton of sense. I think they'll be able to work the MRC business and get more out of it than the team that ran that business will or did. So that's my DNOW. That's my DNOW pitch. I feel like that one could be a good solid hold. UNTC, I don't know. I was going to look at this. All right, I'm going to wrap up with this. I'm going to wrap up with UNTC. UNTC is this they're not officially liquidating, but they're pretty much in runoff, right? Let's see. Well, I don't even do presentations anymore. Here's the second quarter results. So I guess they did have they've historically been, we've got two businesses. They've got the upstream oil and gas business, and then they've got this drilling services rig business, right? And then both of those have been pretty much in decline, and the production on the upstream oil and gas business has been in decline. And then just recently in the latest quarter, they had positive production results. So I could be wrong, but they're paying almost all of it out as a dividend. I think that's the thesis, is they generate a ton of cash. They're really good at managing their P&L and their balance sheet, and they're giving all of it back to you, right? So this is a $29 stock, $1.25 quarterly dividend, and then they do specials on top of that. So even in the last 2 years, you've gotten a crap ton you've gotten the entire share price back in dividends, right? And this is the full year results. Where is this? So this is a GAAP. They had GAAP earnings of $4.80 a share, $4.75 a share in 2024, and so far this year, I think it's more of the same. Yeah, $40 million, $4 a share on a $29 stock, and that's just 6 months into the year. So, oh man, I don't know. I just don't know about these businesses where like it's a slow, steady decline downward, and they plan to give all the money back to you. I mean, maybe that does work. That may wind up being a decent one to add to the top of the pile. So, okay, I'm adding that to the list. Okay, so I've got 11 names now on like the top end of my list. 66 in the just monitor them from a distance, 14 low. I probably need to scrub those and chuck the ones that really don't matter, and then do some more work on these highs. That feels about right. About 10 names on the high end of the list, and let's just see what those are. Let's just sort that. Lionsgate, oh man, I don't know if I'm going to get back into that. Synchronos, yes. Comcast is definitely a watch. That's not high. Site Centers, yeah, that's up there. AMN, yeah, we said that one's worth a look. Lendway, definitely going to take a closer look at that. Pitney Bowes, DNOW, Unit, Sangoma. We didn't talk about Sangoma, but I do really like that stock. I just wrote about that one last week, so I need to add a target there, and will. So that's the high end of the list. 10 names on the high end of the list. Yeah, it feels about right. The things I've written on my paper are probably slightly different from that, but feels close-ish. So, all right, I'm wrapping it up. I hope this was fun. Maybe I'll do this again another time with more structure. Just kind of winging it today. So, hope that worked out. Cheers, everybody. Have a good one.